All right. So we're gonna go ahead and get started. Thank you everyone for joining today. Um, and we're gonna start off just kind of explaining what today's gonna go over. We have Sean, who is a CPA, Chad on here, and myself, and we'll go over introductions in just a minute. But today is really just a high level overview for anyone that's interested in passive investing within real estate. So if you have specific questions, we'll have a Q&A session at the end about anything that we go over either in the presentation today or any questions that you guys came to the table with. There were some questions submitted in advance that we'll also go over. But without further ado, we'll do some introductions. Let's start with Sean. Sean, you want to give a little introduction on yourself and a little bit of background on yourself?
Yeah. So hi everyone. My name is Sean Heinzelman. I'm the president and owner of Heinzelman CPA Group. Uh, about a year and a half ago, uh, I left being a partner at a larger firm to go and start my own uh, CPA firm to kind of provide some more personalized advisory services and tax services. So got hooked up with Focus Capital and it's been a good ride and just trying to provide as much guidance as possible.
Thanks, Sean, and then we'll move. I'll introduce myself, and then we'll go to Chad because he'll take the next part of this. So I'm Jared Shum. I'm the head of investor relations here at Focus Capital. My job is basically interfacing with all our investors. So any written communication when it comes to our reports, any new investors that are interested in investing, they come through me and my team. And then when it comes to any of our capital formation, so talking about any of our assets that you can invest in or any of upcoming projects, that all comes from me. And then we'll pass off the time to Chad, who's the founder and principal here at Focus Capital.
Thanks, Jared. Everyone here, nice to meet you guys today. Thanks for taking time of your day here on noon on a Wednesday afternoon for this webinar. Hopefully, you're going to learn a lot today about taxes, but I want to give you an introduction of myself as well. I founded Focus Capital back in 2022, and that came after a few years of buying deals myself in real estate with my own capital. And really, this whole thing came about in real estate because I had a previous business that I had for about 18 years in the fintech industry with electronic payments. I did pretty well at that. And in 2017, I realized that I had a tax problem to solve. And I really wanted to find a way to lower my tax liability, to reduce my taxable income, to really pay little to no taxes. A lot of research over the next 3 years and met with my CPA. And he also agreed that real estate was probably the best way to go ahead and do that. One of the biggest benefits we saw was depreciation, which we'll go over today. And that's what helped me reduce my taxes to zero in most years, if not very, very little in the other years there as well. Of course, I wanted to find ways to also preserve capital along the way and have it grow accordingly. So real estate just seemed to be like a really good avenue to not only preserve my capital in a in a cash producing asset, but have tax advantages that could offset my income, but also be able to grow it at a rate that I felt was better than other vehicles I've been doing in the past. Still was doing some things with stocks and bonds, that kind of thing, but started really shifting more of my investments heavier into the real estate space. Um, so at Focus Capital, that's part of our thesis here is we want to find investments for investors that are tax advantaged, that provide great fundamentals here, where we help you not only preserve your capital and grow it tax free, but also help you to support going forward.
Thanks, Chad. And so with that, Chad realized that he had, he needed a tax strategy. So he realized he had a tax issue, an obstacle that he wanted to overcome. And so we'll jump into kind of what that strategy looks like now, and we'll pass the time off to Sean since he's the tax professional on this call.
Yeah, so thanks guys. Yeah, so I first want to get kind of started by just giving a higher level overview of how I look at real estate in terms of an investment option, being able to use that in a tax efficient manner, and everything. This isn't like a get rich quick scheme or anything like that. Real estate does take time, um, but it does give you an option to diversify your investments. So for most people, you've got your stocks, your bonds, 401k, and all that. And all of that is subject to market fluctuation. So as the market goes up, your investments are going up. As it goes down, they're going down. Real estate gives you a different alternative to getting an investment in a tangible asset that doesn't necessarily go with the market, and hopefully it's appreciating over time, and you're able to supplement your portfolio with real estate investments. So there's a few different ways that you can do it. Obviously, you can go and purchase a building, a house, commercial building, and you can be the manager. You can do all that. And get the benefits of cash flow and all that, but you're having to manage the property or hire a manager to manage the property. A different way to go about it is to be a limited partner. And this is kind of where Focus Capital focuses on are these syndications where a bunch of people pool their money, um, go and purchase a property, and then you're still able to take advantage of some of the tax benefits with cash flow and everything that goes into real estate. So it gives you just a different kind of alternative to spread out your investments and balance out your portfolio. So this is a very high level overview of real estate investing. You can get into and the tax play with it. You can get into the nitty-gritty. There's examples and everything, but really we just wanted to give a high-level overview of what it looks like as a limited partner investing in a syndication and kind of what you can expect in that. So the first kind of part of it that comes into play is that your cash flow generated from real estate does not necessarily equal your taxable income. So, unlike when you're investing in stocks and bonds and you receive interest, for example, when you receive your interest, that's taxable, and that's taxable at your investment rates, which, if you're in the highest tax bracket, can get up to about 45%. So in real estate, a lot of times you'll receive cash distributions and not have to pay any taxes on those distributions at all. And a lot of these tax plays, it's deferring taxes. So it's not like you can invest your money and just get a bunch of income tax free. A lot of it is tax deferral. So you're deferring the taxes for multiple years until the property sells and all that. So that's where kind of a time value of money comes into play as well. So there's a lot of different alternatives to it. But when you invest in a limited partnership, each year you're going to get a K1 at the end of the year. And that tells you what your income or losses are. And that's going to happen regardless. If you have income or losses, or if you receive distributions. You'll likely receive distributions most of the years as well, and those will go on the K1. But your K1 is going to show you what is income and what's a loss that flows through to you individually. So what happens is the syndication records the income and expenses. That tax return then gets a K1 that goes to the investors, and you report the income or loss on your individual return. What typically happens is, so just kind of going through the cycle of it, you'll invest your money in year one and will likely generate a loss in year one. And that loss is mainly because of depreciation. So the IRS allows you to buy a building that generates depreciation on that building. So just kind of the base is that the building would be depreciated over 27 and a half years or commercial 39 years. Um, but what mostly happens when in these investments is the syndication will get a cost segregation study done, which can separate the asset into 5 year life, 7 year, 15 year, and 27 and a half year. And that lets you accelerate depreciation, which allows you a larger loss up front. So, like using a real life example, if you invested $100,000 in a property, um, that first year you might get a $75,000 loss that flows through to you individually on your K1, which depending on circumstances, because all of this is very individualized, you can either take that loss depending on if you're a real estate professional or not, or if you're not, then that loss will carry forward and offset future taxable income of the investment. So that's kind of the overview of just cash flow and taxable income play and how it does not always equal out because one year you could receive $7,000 in distributions, but your K1 might show a $50,000 loss, a $10,000 loss, just depending on the year, um, because of that depreciation and other expenses um, in the property. So, what kind of happens with those losses um, comes into play whether you're passive, and Jared, you can go to the next slide, whether you're passive or a real estate professional. So, for the most part, what we see are most LP investors have W-2 jobs. They're high wealth individuals, so they're looking for alternative ways to diversify their investment. So they'll invest in these limited partnerships. And so what will happen is they'll get the losses on their K1, but unfortunately, those are deemed passive losses because you're not a material participant um, in the property, and you're not a real estate professional. So um, those losses, they won't be able to offset your W-2 income, but they will be able to carry forward until the property shows income, which they can offset that income, or then until the property sells, and then you can offset gain with that property. So the long play here is that if you accumulate some of these losses, you can sell a property, you can then offset some of that gain with the losses, and then if you invest in another property, you can get accelerated depreciation to offset more of the gain. So the play is, again, it's a long-term play. Um, each kind of holding period is typically 5 to 7 years. And then if you kind of keep rolling it over, you can start really accumulating wealth without having much of a tax consequence to it. Um, so it just gives you another option for an investment, get returns on your investment, but then not have to pay taxes when you sell a stock, when you have interest, dividends, all of that. The alternative to a passive investor is a real estate professional. And again, this designation is very individual specific. You should consult with your CPA and everything because you've got to meet a 4-part test with the number of hours that you work in real estate, how many hours you're working towards the property and everything. So it's very specific. But if you do become a real estate professional, you are then able to use losses from real estate to offset other income. So that can, once you start getting real estate status, that can really start to snowball your tax savings because it not only offsets your income from the property, it can then offset other income. So there's two major distinctions there between investors, and that's passive and then active investors. And then, so again, just high level, just why the tax efficiency matters is being able to kind of receive your cash, not have to pay the taxes on it. It just allows you to continue to compound cash flow without having to pay it to the government right away. At some point, there is going to be a tax hit there. But hopefully, with that tax hit, you're paying the more favorable capital gain rates at a max rate of 25%. And so you're just able to generate cash flow, not have to continuously pay taxes in. And all those tax savings, if you're able to compound those and make additional investments, it can really add up over time. Um, and so again, just kind of the tax deferral of it. This is not you invest your money and you don't have to pay taxes at all. There is a tax consequence, but the hope is that you're able to defer the taxes as long as possible. And then once there are tax implications, one, you can invest in another property and offset those tax implications by deferring it even more down the road, or you're at more favorable tax rates. And the third piece to this is, again, it's all about diversification. A lot of people have their 401ks, stocks, bonds, all of that, but a lot of people want to get into real estate so they're not 100% dependent on the market. And if you followed the market lately, it's a lot of fluctuation up and down. So real estate just gives you an alternative to investing with the hopes of just continuously building up your portfolio in a tax efficient manner.
Thanks,
Sean, that
Sean.
was great. A couple things here, if you don't mind, Jared. A couple
Yeah,
takeaways that I
absolutely.
clear. Um, One thing I wanted to clarify is a lot of people, when they hear about these losses or investors hear about losses, they're like, well, I don't want to have a loss in the property, right? Well, it's a paper loss. It's a phantom loss in that first year. And like Sean said, that can be used as a paper loss to offset those cash flows going forward. And that really is a big value to investors is like Sean said here in this slide, it's more efficient income. You're keeping more of you of what you earn and you're deferring the taxes and the opportunity cost on opportunity for that capital to deploy it throughout those early years that it's not being taxed. That's where the real advantage is that can really snowball over time.
Yes, absolutely. That's a great clarification. So, I mean, just kind of using a quick example, um, if you invest in a property for $1 million, like obviously the day that you buy it, the value is $1 million, your investment's $1 million. Even if that property goes from $1 million to 1,000,001, you're still able to depreciate your investment. So even though the property can be appreciating in value, the IRS allows you to take depreciation to generate those so-called losses. So Chad, you are correct. When we talk about losses, we're not talking about investing your money and losing that investment. It's more of paper losses that allows you uh, that allows that tax efficient manner with the investment. So a lot of times, and I mentioned the cost seg briefly, a lot of people don't want to spread out that depreciation over 27 and a half years. A lot of times the hold period's not that long at all. So you want more depreciation in the 5, 7, or 15-year asset buckets because what that will allow you to do is depreciate all of those costs in the year of the purchase and just increases that tax loss. Again, not investment loss, but tax loss.
Thanks, Sean. I'd add one more thing here to this current slide on number three, complement, not replacement. This is probably the number one reason that people have reached out to us in the last couple of years to look into or to explore these passive investments, alternative investments, is they've gotten tired of the volatility in the stock market. It goes up, it goes down. There's no real ownership there. There's not a tangible asset they can look and go see. And some people just want to have more diversification in their portfolio. Let's put something else in there. It's not another stock, another bond. Let's put a different type of investment vehicle in here to where they do have some more like they know the ownership in the property. They know where the property's at. It can't go to zero. It's a real asset. It helps offset inflation. So that's probably one of the biggest reasons that people have looked at these investments the last couple of years is because of number three there, just a way to diversify.
Yeah.
Perfect. So I think that one of the big things that we wanted to go over today. Sorry, Sean, did you have something to add?
Nope, nope. Just completely agree with what Chad said.
I think something that a lot of people are interested in seeing is like, so we know Chad's story, why he got, interested in real estate investing as a vehicle for that tax play. Sean discussed where those tax advantages lie at a very high level, but it'd be probably helpful for a lot of people for us to run through what that type of investment would look like in a very real scenario. And these are all sample investment returns on a very real property that we have in our portfolio. This was our latest acquisition. So I'll let Chad kind of drive this part of saying like where that cash flow comes from a distribution standpoint, like Sean had mentioned on one of his first slides. And then the next one will go over kind of what that cost seg and depreciation looks like. So, Chad.
Yeah, thanks, Jared. So at a high level, a lot of numbers here on the screen, guys, but this is taking a sample investment of $100,000, for example. And this is going to show you year 1 through 7 on the bottom right box here on what the projected cash flow distributions are to you as an investor if you were to invest 100 grand in this property. And you can see year one is 5,438, year two, 6,688, and so forth. And we'll get through depreciation here in a few minutes, but that's how you can see how part of the return on your investment should be occurring throughout the whole period. And then the other part of the return comes when we sell the property. In this example, year 7. So in year 7, you can see that we will be returning $190,000 back to you as an investor, which would be really from the gain of the sale. And that is where a majority of the return comes from. That's where you have a capital gain tax at a lower rate than ordinary income. But I hope that helps. Jared, add more there if you want to.
I also think that it's important to note that a lot of people will see some of these numbers in the bottom right-hand corner, and these are annual distributions, and we distribute here at Focus Capital quarterly. So the easy maths on that is that you just would take that 5438 and divide it by 4, and then those are those targeted distributions by quarter. Distributions can vary depending on the asset type. We have three strategies here at Focus Capital. We have our development strategy, which is basically ground up. We have our value add strategy where we would acquire maybe an older vintage asset and then kind of restore that and add more value. And then we have our core plus deals where it's a newer vintage asset where we're driving higher occupancy rates. For a development deal, you're probably when you're looking at these deals, there might not be distributions in year 1 or year 2 because a lot of that cash flow comes from tenant rent. And if you're developing a property and you don't have tenants in it yet, a lot of your returns are going to come in that year 7 if it's a 5 to 7 year hold. So something to consider when it comes to your distributions and cash flow. And if you're looking for something that has a higher cash flow, but maybe a smaller equity multiple, then you're going to be looking at a different type of asset than if you're just looking for a larger return on the other end. And so it's important for you to talk to, your financial advisor, your head of it, IR of whatever firm that you're with, and then also your CPA of what strategy is going to fit for you guys.
Yeah, and just kind of using this example here, just at the bottom right. So that $100,000 investment it could generate anywhere from, I mean, in this particular one, about 75 to 80,000 of tax losses. So again, if you're an LP investor, passive, then you're not able to, if you don't have any other passive income or anything, that's a big caveat there. But if you don't have any other passive income, and this is your first investment, let's say, that $75,000 tax loss doesn't really do you much good this year. Where it will come into play is in the following years when you start receiving distributions and all that, and the property starts producing income, then those losses carry forward and are able to offset all of that future income up to those losses, which so as you can see in years 1, 2, 3, 4, 5, and possibly 6, you're not paying any taxes on any of the income or distributions that are flowing through to you because you have carryover losses. So that's when we're talking about tax deferrals, is you're able to defer all those taxes, and then in the year of the sale, your gain is going to be larger because you've taken losses and all that. But there's a more in-depth play in here where in the year of a sale or distribution event, if there's a refinance or something, if you make another, that is deemed passive income. So if you then take that money and make another investment, either 1031, which won't get into too much, but if you just receive the cash and then investment in another opportunity, then that's where depreciation and that cost seg can come into play. Because if you did another 100,000 and you receive a $70,000 loss in the year of the sale on the other property, you're able to then take those passive losses and offset the passive income from the gain. So that's where once you start getting going with the investments and you have liquidation events and all that, there's a more advanced play here where you make additional investments and then those investments and tax losses are able to offset gain from the sale of the property. So it can get a lot more complicated. We're just trying to keep this at a high level, but just as they went through this, just kind of wanted to lay out how that tax play works.
Yeah, that's a great point, Sean. I think that speaking on behalf of our investors here, a lot of our investors will roll their liquidation capital into a next investment, our next portfolio. And that's kind of what our investment thesis here is that every time we have an exit event, like you said, whether it's a refi or a sale, that we have an opportunity that they can place their capital into. So that way we can help them with that tax strategy, and then also so that they can continue to generate and aggregate more wealth in the real estate investment space. Because a lot of our investors will start with that 100K minimum, but then their next investment might be 250, and then as you can see, obviously it snowballs from there. Something that Sean had talked about is that depreciation, and so through a cost seg, you're able to write off depreciation deduction in year one, and I'll let Chad and kind of Sean talk a little bit more about that. But as Sean had mentioned, it doesn't help you maybe right away, especially if this is your first investment, and it can't offset your W-2 income. But with all those distributions that roll forward, if you have a cash flowing asset, those are things that you can realize as you get those distributions. Chad, do you want to take over this slide?
Yeah, thanks, Jared. Yeah, this is a lot of numbers here as well. This is a deck from our previous investment we acquired last October. But at the very bottom right, let's focus on the tax advantages. And this particular investment, if you put 100K in this investment at that point in time, you would have received an $80,000 depreciation loss in year one, which would be for 2025 last year. So all this is showing you is like we put in these slide decks, and if you look at other deals from somebody else that should be in there as well, it should give you a forecast or an estimate of what that potential tax phantom or paper loss should be in year one, as a rough number there. So again, $80,000 was the paper loss approximately for year one on a 100K investment for the first year.
Sean, anything to add here?
No, I mean, I think just kind of similar to the last slide and before is if you have other passive investments, then that 80,000 deduction can come and play in the first year. But again, real estate is more of a long-term play, better ability to broaden your investment portfolio and everything. And it just gives you additional options.
Perfect. We're going to move into the Q&A portion of our section. So if anyone who is online right now wants to drop something in the chat or anything like that, I'll start with some of the questions that were submitted in advance. So this question is for Sean. Sean, when should investors and at what point in the journey should they involve their CPA?
Well, I think where I view the CPA investor relationship is more of a partnership in terms of an investor has a CPA that's their advisor. They've got a financial advisor that's helping them with their investments and everything, potentially an attorney. So I think it works best when everybody's working as one and are in communication each year. So it's more so like not necessarily a specific point in time, but I think having kind of all of those professionals together and helping build out a forecast that's best for that particular investor because each person's situation is different. I think it can only do good having those people in the room kind of forecasting the future and helping make the best decision for each investor.
And then, what are some common misconceptions about real estate tax benefits? We talked about obviously what the tax benefits were or at a high level, but are there any common ones that you've seen that are just misconceptions that people come to you with?
Yeah, I think the biggest one is the passive losses. I think a lot of people don't realize they're like, I made a lot of money with the W-2 job. I paid a lot of taxes. Everybody talks about real estate and being able to offset taxes, so they think that they can make an investment and then all of a sudden they're able to offset their W-2 wages and not have to pay any taxes. And unfortunately, that's not the case. Your W-2 wages are active. The real estate investments are passive, and only passive losses can offset the passive income. So I think the number one thing is I made a big investment. I have a large loss. I'm able to offset all of my income. And unfortunately, that's not the case.
Sean, I'll give you an example here because that has been a big question with investors, and it's important you have the right information from different people you talk to, and obviously consult your CPA. But yeah, some people have thought, well, I make X amount of money in my W-2, I can offset my taxes with real estate. Not the case, right? Obviously, I talked to our CPA, but there's a couple of unique situations that we've had investors um, bring to us, and I'll let you answer this, Sean. But so let's say that I'm a W-2 guy, I make a good income, and my wife decides to become a real estate agent, or maybe she has like Airbnb. Am I able to, because we're married, we'll file a joint, am I now able to do a passive investment and use that loss against our joint shared income?
Uh, it is possible, but it is also dependent on kind of activity level at each property. And so you actually did bring up a good point with the Airbnb as well, is that Airbnb is actually owning an Airbnb is different. The IRS views that differently than a long-term rental. So Airbnb is short-term rental and everything. The IRS views that actually as a trader business. So if you have an Airbnb, then you're actually able to take those losses and offset income because they view it as a trader business, and um, therefore the losses aren't passive. So that particular one, it's not deemed passive, so you're able to use those losses. Becoming a real estate professional, so the IRS scrutinizes that a lot, whether you're a real estate professional or not. So being able to use, I mean, if your spouse is um, a real estate professional and everything, then it might open up some different areas where you are able to invest some money in real estate, and be able to take some of those losses to offset that income. But again, it's very individual specific, and that's where you need to have um, kind of your CPA and advisors involved in those decisions.
Thanks, Sean.
And Sean, we just recently sent out all of our K1s to our investors. And so I was curious if you could kind of just go over how depreciation typically appears on K1s.
Yeah, so I mean, so your K1, what it's really doing is taking the business tax return and flowing it through to investors. So the depreciation is just going to show up as, I mean, it's ordinary loss. So it's just gonna, you're gonna receive your K1. It's gonna probably show an ordinary loss. It'll have some interest income and everything. But the K1 is kind of similar to a W-2, and it's showing you what income or loss to report on your individual return.
Great. I think that we're going to wrap up here. If anyone has any follow-up questions after this or would like access to this deck, I'll email this deck out to all of our attendees. But I dropped all of our emails into the chat. So all of them is just first name at company.com. But everyone is able to reach out to us individually if you have any questions on anything we went over today or anything related to real estate investing. I think it's important for us to let you know that while Sean's a tax professional and we're real estate professionals, this was an educational session. So it's not personalized tax advice. So we would always encourage you to consult with your CPA or one-on-one with Sean. And then you can obviously follow up with either Chad or I on if you are looking to invest in any type of passive real estate. The last thing that I would add is if there is something that we didn't go over today that is more in depth, like what Sean had said about 1031s, investing with a self-directed IRA or anything like that, we will have future webinars that we can go over those things. But if you're really looking for individualized advice for your individualized situation, feel free to reach out to any of us. Gentlemen, was there anything else that you guys wanted to add while we were still online?
No, that was great, Jared.
Yeah.
Good job moderating and leading.
Yeah, well, thank you so much, everyone, for joining, and we'll hope to hear from you guys soon. Have a great rest of your guys' day.
Thanks.